that a lot of people will talk about, from a private equity backed business to, we'll just say non-private equity backed business. Could be public, could be private, could be venture capital, whatever. Is that speed is everything.
Welcome to the 1% Edge podcast, where we dive into the journeys of extraordinary guests committed to getting 1% better every day. Today's hot topic: value creation in a private equity SaaS environment. And to help us out with that, I'm honored to have John Lepto IV, Chief Revenue Officer at Clear Go-to-Market. Welcome, John.
Thank you, sir. Good to be here today. Appreciate it.
Excited to have you on. In fact, it's great. I even got somebody that's in the same state as I am, so that's a nice little start.
Same state. Like I said, we were talking earlier, looks like I'm looking in a mirror, so that's good. Two good things.
For our audience that aren't seeing our faces, it's a mirror of himself many, many years into the future. In other words, I look a lot older.
Yeah, two bald guys with a beard.
So, yes. Well, John, hey, to get us started, I personally have seen more and more private equity ownership within my clients.
Mm-hmm.
Maybe this would help us, our audience. Could you help us start with, what is private equity, especially compared to VCs, which, venture capital, which maybe other people are more used to?
Yeah, no, that's a great first question. The easiest way to delineate between what is a venture capital firm and what is a private equity firm is venture capital. You think of like the Ubers of the world. Venture capital firms will invest in those early stage, almost startups, right? They're investing a large sum of money that is going to pay off much farther down the road. When you think about private equity, and actually there's a couple of classifications. There's actually what I would consider growth equity, and then there's going to be mid-market private equity, and then large cap private equity. That's kind of the full spectrum of what private equity is. But very simple terms, private equity invests in much more mature businesses that is going to have a faster payout, right? So private equity invests in deals or makes acquisitions in companies and usually have a hold period historically from about 3 to 5 years, maybe 5 years usually. Now that hold period has extended in recent time just because of the market has changed, debt is more expensive, interest rates, etc. But historically, that hold period is about 5 years. I think right now it's trending 6.5-ish, upwards of that 7. But when you think about private equity, right, they invest in mature businesses, and then venture capital invests in much more risky businesses that don't have any sort of true necessarily go to market, not yet, maybe they don't have product market fit yet, but they're making a big bet. So growth equity is going to be more in that lower middle market or even lower middle market space. So call it sub 10 million in top line revenue, maybe 15, 20. Mid market is going to be anywhere from 10, 15, 20, 25, upwards of 250 ish. Everyone has different numbers. And then the large cap might be 250 or 500 million and above.
Is there more private equity deals and firms today than before?
Oh yeah.
Or maybe I'm just noticing them.
No, a ton more. I don't have that data, but I mean there are thousands of private equity firms, and everybody knows the main ones: KKR, BlackRock, Bain. I could the list could go on. LLR Partners, Francisco Partners, tons of companies out there that invest. Riverside, just a few of the names that are coming to mind, but there are tons and tons of small, lower middle market and mid market private equity firms, and they invest across all different types of businesses. Each one will have a little bit of a different thesis for each fund, and that's another thing is when you get into the actual private equity space, every firm, will start with one fund where they go out and they get investment from some of the limited partners, et cetera, to raise money to invest. And then that fund will close once they've reached the amount they want to raise, and then they start to invest over a certain time period. Then they might open up another fund, and each fund will have a different thesis. Each portfolio company they invest in will have a different thesis and value creation plan, which we can get into. So it's very, if you're in the space long enough, you know it. But to the modern person who's not been around PE, it can seem a little bit crazy and difficult to understand. But it's really not.
Well, I appreciate you being on the podcast and helping us to get us some insights. In
Absolutely.
fact, why don't we define the next? So, what do you mean by value creation in a private equity SaaS environment?
Yeah. So I think I'll start by saying there's been a couple shifts. One of them has happened in the PE space. So there, historically, the old school model of private equity was to, make an acquisition and what a lot of people call financially engineering their way to good returns for the firm and the limited partners. Now, basically, what I mean by that is they would run their strategy and have their associates crunch all the numbers, for lack of better words, and they would own that company and run it operationally for the next 5 years, maybe cut some costs here, um, and kind of like Excel spreadsheet their way to good returns, which you could do, right? Money was cheap, interest rates were very low, and that ability was there. That's not the case anymore. So, private equity has taken a very big interest in what we call value creation. Value creation depends on who you talk to, could mean a number of different things. There's a guy who is very big in the PE space that a lot of people know. Actually, his name's Dan Kremens. But I don't want to quote that I've come up with this on my own because I'm taking it for him, but he talks about value creation being very simple definition, which is anything that will increase the enterprise value at the end of the deal, right? So anything that the operators at the firm or ELT, sales, marketing, customer success, you name it, in the actual portfolio company does to improve that company so that at the end of the hold period, they can sell it for a larger amount than they bought it for, right? Enterprise value. So for my specific case, when I think about value creation, being CRO at Clear, go to market, we work with a lot of portfolio companies. So anything that we can do to help increase revenue, right? Anything that we can help do to help increase revenue of the portfolio company is where I play and where I'm very interested in when it comes to value creation.
Excellent. Um, you've been on both sides. The audience doesn't know this yet. So you've been on the private equity side. You've been on the assets that's been invested in side of it. Any advice you would have for other sales leaders or marketing leaders actually in dealing with private equity to make that relationship more successful?
Yeah, that's a very loaded question. um, yeah, you could get a lot of different answers to that. I think the biggest difference that I've seen personally, and that a lot of people will talk about, from a private equity backed business to a we'll just say non-private equity backed business, could be public, could be private, could be venture capital, whatever, is that speed is everything. As soon as the deal is done, even before, like say, call it pre-acquisition, right? When they're in pre-acquisition diligence, it's almost like the clock has already started to tick. But it definitely, as soon as that acquisition goes live, right, the clock has started to tick. So if you are a CRO or a CMO or really anybody on the ELT team, you have to work very diligently towards that thesis that the PE firm and value creation team, if they have one, most likely the deal team, has put together for that portfolio company. The one key piece of advice I would give off of that is to fail fast, right? Private equity, of course, they're going to care if you fail, just like anybody would, whether it's PE backed or not. But you have to move very quickly. And if you're going to try things, that's fine. We all have to try things, especially when you think about go to market and decisions that go into that. But if you're going to fail, do it once, right? And then secondly, do it quickly. So if you get in there and you try something new, you better be able to iterate very quickly and pivot. That's probably the biggest piece of advice I could give, because there are plenty of C suite members that get into a private equity backed business, whether it's at the beginning of a hold period, in the middle, at the end, maybe there's a turnaround situation. And if you can't operate at a very efficient and high paced level and speed, you're probably going to fail.
It's one of the things I've noticed is so private equity comes in, whatever leadership team is that they have confidence is there. It's a year or two in. If they're not succeeding, I mean, I've seen like almost the entire C-suite flip over. I mean, there's an account that I work with, and I mean, only one of the guys that I met a year ago is still there.
Yeah.
And so is that common where, hey, look, if it's not executing, come to your point quickly, and they don't see a plan, that they'll wholeheartedly, hey, bring a whole other leadership team in there to see if they can turn it around and turn it around quickly.
Yeah, I think historically, yeah, that's the unfortunate part is when you're in a business that you have other people's money invested, you have to produce results, right? That's what private equity is all about at a very, in layman's terms. So historically, yes, I think there would be a fell swoop of the ELT. I think in today's society, you think about all the different C-suite members, but you think about like CEO, CFO, CRO, CMO, maybe CSO or Chief Sales Officer. Those titles are 18 months, right? That's the average tenure. Now we could get into what my thoughts are specifically around like the CRO, CSO, and CMO, but it does behoove the question of like who's dropping the ball? Is it the talent team? Is it the person they're hiring? Is it both? Is it the situation? And there's probably a little bit of all of that in each specific scenario. But yes, I think if you can't achieve results, they will find somebody else to do that. Now, I don't think if they're a good private equity firm, they're not going to clean house of an entire ELT team. They might, they will do it very strategically and maybe one person at a time. And usually there will be one head to roll, which in a lot of cases can be the CRO, right? If they are truly a CRO, which in my opinion of what is a true CRO, it's somebody who has and owns the entire revenue function from sales, marketing, customer success, demand gen, sales ops, rev ops, all of it. So a lot of times that person can be on the chopping block sooner than others.
Agree. And it also seems like it's kind of a little team sport environment, and I'm making fun of it a little bit, but they bring in a new CEO. CEO has his group of go-to people. They all parachute in, take over, and they run their playbook. And the whole idea is to turn this thing around. And sometimes it's, like success is just getting the asset sold to another private equity
Right.
firm that's going to take it the next leg. And is that pretty common?
It is. No, you're exactly right. And when I think about that, right, you think about a deal when it gets bought, right, or acquired. A lot of what goes into that diligence period at the PE firm level or the fund level is figuring out, okay, the current ELT team, is that who we want, right? They're going to be interviewing those people to figure out, are they the best to get us to the next spot, right? It's the old saying of what got us here won't get us there, right? So I wholeheartedly believe in that. You can be a great leader from 0 to 10, but maybe not from 10 to 50, or the numbers can go on, right? If you're a great leader from 0 to 100, you might not be the leader to take them to 250. So yes, that does happen quite a bit, but you'll hire a new CEO. That's usually where it starts at the top, and then a lot of times they'll get some sort of purview or operating power to say, well, I've got my people that I know that I want to hire. You know what I mean? And they get plugged and play. But
Yep.
even sometimes, just because the CEO has worked with these people in the past and they've done well, doesn't mean they're going to succeed in this new venture. But to answer your question, yes, that does happen quite a bit.
You were talking about speed. The other thing I've heard recently is like, I've heard this from a couple of good friends of mine. Hey, I'm going to this company. It's private equity backed. They got a 2 year window. You know, they bought it 2 years before. They tried things out. It didn't work out. They got a 2 year window, and clock's ticking. Is that usually the mindset? If you were a sales leader going out there and the firm is private equity owned, is that usually the game plan in those types of scenarios?
Yeah, I think as a C-suite or ELT member, if you are going into one of those companies or you're interviewing in one of those companies and you know that there's a 5-year hold period, they're 3 years into said hold period, you're replacing somebody that couldn't make it work. So you need to do as much of your own due diligence into that company as you can. Now you can't get everything, but you really need to truly understand what is going on with that company, with the metrics, what's worked, what's not, and you got to you have to interview them as much as they interview you, because at the end of the day, I mean, your job, your livelihood, your bread and butter, which what you make is on the line, because your timetable is even shorter, right? The other person had 5 years, now you have two. So it's a turnaround situation, and private equity will look for turnaround people, like a turnaround CEO or a turnaround CRO, someone that's been in that situation before and has had success, because PE is all about hedging their bets, right? They want to make sure they have the right people in the right seats to take them to where they want to go. But yeah, I mean, that does happen a lot. And I think a lot of people will look at that situation, and unfortunately, I think ego comes to play, right? I can do it, I've done it here. Or even if they haven't, they're like, well, I can do that. And you think about what's positioned to you at the front with the compensation package and the equity package, and it's like, well, I can get equity and get a great payout in a short amount of time instead of 5 years. But the thing is, you also could be out on your ass in 6 months if you don't make it work. So is it really worth it? I think you can kind of tell the point I'm making is you really have to do your diligence on these companies to figure out, is it a good situation? And you might want to pass. You might want to pass on some of these, because some of them are inevitable of not failing. Or I'm saying that right? Yeah, it's inevitable that they will not fail, or they will fail, right? So you just try to figure out which of those situations are on your plate.
You're walking
Yep,
into.
how to get around.
All right. So another little aspect of this, and maybe it's just so a lot of times we think of private equity as buying the entire company, but I've also seen where private equity only buys a percentage of it, and then either I guess another private equity
Yep.
firm or another third party has another percentage of it. Is there a common scenario you run into, or it could be any of the above?
It's based off the firm, right, and their own the individual firm's kind of thesis to how they invest. So there are big firms out there that only take majority ownership or majority controls, like that's the common phrase you'll hear. And then there's some that will write smaller checks, and they're okay with going in with another firm or even multiple firms. A lot of that happens more in VC, like in the early seed rounds. But there are private equity firms that will go hand in hand in tandem, and take some minority shares just to have a stake in the company. And then it can get a little hairy, but usually, right, the PE firm that owns the majority of the company is going to be the one making the decision. So, like for somebody like us, right, Clear, when we are working with a portfolio company, a lot of times, and this goes back to the value creation theme, but a lot of times we will come in through the private equity firm level. And another thing that's really good to note for just the listeners is, tied to value creation and tied to this shift from financially engineering your way to good returns to now value creation, has been ushered in with go-to-market operating partners. And actually, operating partners as a whole, um, it's nothing new, right? There've kind of been like these ex CEO type operating partners that can advise on a lot of different things. And then there's more function based. So, like a CRO or go to market operating partner. Might be a CRO, might be a CMO, right? But these are the people that we will work with at the firm level, and we'll come in and say, this is what we can do. And there's lots of companies and vendors that do this, and then they'll put you on a certain portfolio company to parachute in and help. But a lot of these go-to-market operating partners, their main job is to have purview over a certain amount of portfolio companies and help on a number of different things underneath that go-to-market bucket, right? Um, but that is the big shift that's happened. So private equity, in my opinion, their number one thing today is really understanding go-to-market because they haven't. They've financially operated and engineered deals in the past, and they've been able to do it pretty successfully. But now in this world and market where interest rates are high, debt is not cheap anymore. Deals are hard to come by, and the hold periods are having to be extended because they're not able to reach the revenue thresholds and sell it for what they wanted to. You have to lift open the hood of these portfolio companies and, like you mentioned, parachute people in to help fix what's broken. And a lot of times that it's not just going to be on the C-suite. You have to have that outside advisory who's been in that role before, who's been there, done that, and can come in and help advise or even really like get hands-on with the portfolio leaders to help move the needle.
Interesting. What might be some of the biggest mistakes that leadership teams make in dealing with private equity?
Yeah, that's a that's another loaded question. Um, so I think one of the common mistakes just might be more of a like a mindset. And I mean, you don't, just like anything in life, you don't know what you don't know until you know it, right? So until you actually have some exposure to that first private equity firm that owns your business, it's hard to know how to operate in that space. But I think one of the biggest mistakes is to not take what they say at face value. I mean, when they come in, you'll if the company is doing well, you're not going to hear from them, right? They're going to be off doing their thing and they're happy because the numbers are great. You show up to the board meeting with good data, good reporting, good numbers to present. Everybody's happy and goes home. But it's as soon as the numbers start to slip, then they're in your business constantly. And it's tough because now you're running a business and also reporting to the people that own you and having to answer a lot of tough questions. So I think one of the biggest mistakes, actually, going off of that, um, is lack of preparedness, especially in board meetings. Because if you are on LinkedIn, you see people talk about this all the time of how new C-suite members show up unprepared and just get chewed, right? Get chewed out. And you do that, and it's almost kind of like a rite of passage to becoming an ELT member or a C-suite member. That's good, because then you don't do it again, right? You don't want to be embarrassed in front of all your peers and go through that. So I would just say you got to be prepared. You got to put a ton of work into it. And I mean, when your peers are not responding to you, that means they're probably heads down preparing for that board meeting that's next week, and they're sweating bullets until it's over. And then I passed another day. I can live to see another day at the company, and then until the next board meeting.
Yeah, the common thing I was hear is like you got to know your numbers, and you kind of know it from different
You
perspectives.
do.
And I'm curious. So when we think about value creation, right? There's overall revenue, there's margin, there's cost structures. Is there? I mean, obviously, you know, the PE firm wants a return, but you want to build a growing business, and sometimes you got to invest to
Yeah.
grow, right? You can't save your way to prosperity. Um, how do you navigate through that? Any advice there? Like, how do I convince the P firm that we might not get the growth that you're looking for this quarter or next quarter, but this is going to start paying dividends in Q3 and Q4?
Yeah, that's tough, right? I think kind of like what you're asking is how do you show the ROI for something? And my best advice is you just have to get out in front of it. as early as you can. The last thing you want to do, I guess this kind of goes back to your other question of any advice on how to avoid some mistakes. But the last thing you want to do is have the problem present itself and then you're bringing it up, right? You have to be, goes back to my point of being prepared as you can, but the faster and quicker you can get out ahead of these issues that you're seeing down the tunnel or down the roadmap, the better, because then you can bring it up to the private equity team, the deal team, whoever it is on the board, so they're at least aware of it. Now you want to be careful. You don't want to let things, the cat out of the bag too soon, and then it doesn't happen. Then people are freaking out for no reason. But you got to use your best judgment. But if you can find a strike a balance between talking about the things that absolutely need to be discussed to get out ahead of it, that is probably one of the biggest things that's going to save you, and also build some cadence with your board members.
Excellent. All right. Uh, so, John, I really appreciate the topic, and it's an interesting one. I kind of want to get more and more in the numbers, but I'm running out of
Yeah.
time. How about you tell us a little bit about yourself? How did you get so knowledgeable about dealing with PE firms?
Yeah, I mean, so I've had a traditional sales kind of career, started in commercial lending and finance and healthcare, and then most of my career was healthcare tech, B2B SaaS companies. I worked for, ironically, a Warburg-backed portfolio company in the health tech space, so I had seen that side of things, and then I went and worked for a company in the commercial office of the CFO space that sold professional services into private equity, and they used us at the portfolio company level. Then I actually went and worked for a private equity firm, a lower middle market firm, as an operating partner focused on go to market and sales and commercial. And now, kind of topped it off with being CRO at Clear Go to Market. So I've seen a lot of different, almost all the different angles of private equity outside of just being like on the actual deal team and coming up that route through investment banking. But now at Clear, we are doing two things really well for private equity portfolio companies, and it's win-loss analysis and competitive intelligence. And we do it specifically for private equity-backed B2B SaaS companies. And what we can do is we can work with these go-to-market operating partners and pull on what I consider and what I wish I would have known when I was an operating partner myself is one of the highest ROI, lowest lift levers, value creation levers that somebody can pull, which is just really, truly not only just helping you understand surface level why you win, lose, and churn, but finding that deep, qualitative primary market research, what I call like buyer intelligence as a service or BIAS, and helping these teams uncover and diagnose gaps within their go-to-market to help them drive revenue and grow. So that's what we're doing now. That's how I've become knowledgeable, and really it's just learning, reading, and being a sponge from all the types of people in the industry.
I think it's awesome. I mean, let's face it. Well, I believe that the biggest lessons you learn are not always from the deals you
Yeah,
win. It's from the deals you lose. When you go back and you really self-assess what really happened here and what's really going on in the marketplace. A lot of times I think companies make assumptions. They make assumptions about their product and why it's being purchased and the value it has. And they make assumptions about their competition. And a lot of that's just frankly not getting to know your customers well enough to really understand that. And it sounds like the Clear go to market really goes in and helps you figure that out.
yeah, we do. It's a great company. We're getting a lot of traction, and right now we're really just trying to evangelize who we are and what we do and how we can help PE-backed businesses in this market. Where really, I think the biggest thing that portfolio company leaders and private equity go-to-market operating partners want is clarity. Clarity around your go-to-market. Help us understand what we need to be doing more of and what we need to be doing less of, and that's what we can help them understand through our programs.
Yeah, except another thing I've seen with private equity, sometimes they get the bigger picture and they'll buy multiple companies in the same segment in a thought of pulling them together and creating a bigger
Yeah.
player. So some of the research that you do on the competitors and why you're winning, if you think of it across companies, I think would be really insightful for a private equity
Yeah,
firm.
buy and build strategy. That's typical.
Yep. So, hey, so what's your 1% edge? What are you working on these days to get 1% better every
Yeah,
day?
so it's a great question. I know it's the topic and title of your podcast. So for me, I actually took a lot of time thinking about this. So my 1% is over the last, call it 7 years. I'm a big proponent of figuring out how to be comfortable in the uncomfortable, right? And that can mean lots of different things. And really, that is earned, right? Not given. I'm a big runner. So, a lot of what I do to do that is going to what I call the pain cave. And you just have to really figure out how to operate in a state of being uncomfortable, because when you're uncomfortable, that's where change happens, and when change happens, that's where growth happens. So I'm not about competing with other people or really even myself. It's just about how do you gain progress day after day after day. So that's the biggest thing that I work on, and it's not just professionally or personally. It's both. It's what are you going to do that is really making up your DNA, that's going to turn you into a better person that will show up on both sides. So that's my 1%.
I love it. Growth comes through struggle. I stole that from someone. I can't remember where. There's also another famous, I think it's the Navy SEALs,
Yeah,
saying, when times of stress, you don't rise to the occasion, you fall to your level of
that's right.
training. And it kind of goes along with that, right? A lot of us think that, hey, when it gets tough, I'm going to rise up to that. The reality is, it's the effort you put in and day out that's really going to be your baseline.
Daily struggles, man. That's what makes you better.
Awesome. Well, hey, John, if someone wants to get to know you better, what's the best way for them to reach you?
Yeah, the best way to reach me is on LinkedIn. I'm pretty active on there, blog posts and just kind of weekly and daily insights. So, John, I think my LinkedIn name is John E, middle initial E, Lepto the fourth. Or you can find me at Clear GTM. But that's the best way is probably just to reach out on LinkedIn and connect with me there. And we'll see what we can do to help each other out.
I appreciate it. Thanks for coming on the show. I learned a ton. I really appreciate it, John.
Thank you, sir.
All right, folks, that does it for this week's episode. If you enjoyed it, please comment back, subscribe, and if you will, maybe give us a 5-star rating. I'd greatly appreciate it. Until next time, I wish you nothing but the greatest success. Thanks, John.
Thank you.